Get the power to do more with Sparefoot Marketplace. More reach, more leasing, more toward your bottom line. Storable helps operators do more with the most powerful technology in self-storage. Learn more at storable.com/do-more.
Hey, good morning, everybody. My name is Matthew Beal. I'm a product marketing manager here at Storable, and I'm going to be your host for the 4 Operator Imperatives webinar series that we're officially launching today. But before we get started, we wanted to review really quickly where we've come, and then we want to give you guys an idea of also where we're heading. So 2 weeks ago, we had our conclusion to the Navigating Uncertain Times webinar series, and this was specifically focused on helping operators solve the unique business challenges that were presented by COVID-19. And we had some really great conversations with owners, operators, vendors, subject matter experts over the last few months on these topics. And I'd highly recommend that you check out the recordings of these. You can find them at blog.storable.com if you missed any of them. But today, we're really excited to launch our next webinar series, which we're calling the 4 Operator Imperatives. And we have 2 great guests who we're going to introduce momentarily. That'll be joining Chuck Gordon, the CEO of Storable, for a conversation on the state of the market before COVID-19, what was happening when it hit, and then what we've seen since then. And we're also going to be discussing the 4 Operator Imperatives themselves, which are 4 clear, actionable steps that you can take to put your business kind of in a position of strength in the face of those market forces. And then in 2 weeks, we're going to be diving into the first of those 4 Operator Imperatives, which is optimizing your marketing spend. And the first conversation we're going to be having on that topic is going to be covering the essentials of SEO, or search engine optimization. And we're going to be discussing steps that you can take to improve your SEO and how it can be one of the most cost-efficient elements of your marketing mix to ensure that you're getting the most bang for your buck. And we're also going to have a couple of guests who are experts on SEO joining us for that panel. So please be on the lookout for more details in an email early next week. But without further ado, I want to jump right into today's conversation. And so I'm going to pass the mic over to Chuck Gordon, CEO of Storable, who is going to be moderating our discussion today. So Chuck, take it away.
Awesome. Thank you, Matt. Very happy to be here today. Glad to see you guys again for the new webinar series. We're really excited to get kicked off. For some context and just kind of set the table for today's discussion, before COVID and since 2015, the storage industry had been looking at totally unprecedented supply growth for that set of years. But more recently, over the last few years, we had seen that consumer demand wasn't really keeping up with that growth in new supply. And operators had been kind of starting to realize that they needed to think about getting more efficient with their operations. That was all pre-COVID. And then when COVID hit, that materially accelerated the gap in consumer demand compared to the new supply. And that created kind of a perfect storm situation of increasing supply and decreasing demand. And so we don't believe that this is doom and gloom by any means. And as we all know, self-storage has been extremely performant relative to many other industries. And for that, we're all very lucky and thankful. But challenges do remain. And so we created this webinar series to help you combat these market forces that we're all facing today. So on this session, I'm excited to be joined by 2 guests, and they're going to help us better understand what's going on in the market and where they see it going. So first is Eppie Vojt, who is the VP of Consumer Demand for Storable. And Eppie leads our marketplace business, AKA Sparefoot. And so using the data we have from the Sparefoot side of things, he's uniquely equipped to help us understand the buying behavior of our prospective tenants and how they're thinking about shopping for storage today, before, during, and after COVID. And then second is Cory Sylvester, who's the principal of Radius, the industry's most comprehensive location intelligence platform. And Cory's uniquely equipped to help us understand the forces on the supply side of the equation. And Cory, we definitely appreciate you joining us here today. Okay, so I thought we'd start off the conversation by painting a picture of the state of the industry before the COVID health crisis. And so Cory, I'd like to start with you. First off, would you mind starting with an explanation of Radius and kind of what type of value you actually provide for operators?
Happy to, Chuck. Thanks for having us on here. We started Radius 4 years ago, and ultimately the niche that we saw was that no one had figured out where every facility is, how big it was, where all the pricing was on a daily basis, where all the development activity, and taken all that information and tried to create a cohesive platform that could allow an operator or a developer to simply understand the markets around them or the markets that they're interested in entering. And so we capitalized on that and figured out how to track every facility in the country and track the pricing on a daily basis and wrap all those different data sets into an online platform that is Radius Plus today.
Awesome, that's great. And I've seen the product; it's fantastic. So, how has your team been tracking over the years, or what has your team been tracking over the years leading up to this crisis? And how would you characterize the state of the industry kind of pre-COVID?
The state of the industry pre-COVID, if we think about the industry coming into 13, 14, 15, is you were seeing unprecedented revenue and NOI growth. And what that did is that attracted a lot of developers that were taking advantage of being able to build a facility at a 9 or 10 cap, whereas the existing stabilized facilities were selling for 6 caps. So that spread in between what you could build at versus what you could buy really fueled an enormous amount of development activity. And as you can see on the construction put in place chart, which exacerbates the growth cycle a little bit, but it tells a story from a directional standpoint, which is that we just went through an unprecedented development cycle, coming into 15, into 16, into 17, and finally peaking in 18. We had the largest development cycle that we've ever seen. And so if we hop to the next slide, what we can see is if you look at the growth, you very quickly from 16 to 18, almost doubled the square footage growth that you saw in the top 50 markets. And roughly speaking, across the country, you were seeing in 17 and 18, roughly 1,000 facilities deliver new openings every year. And that's what we track pretty closely. We were on pace to keep with that in 2020. Obviously, COVID has stopped in its tracks a lot of that development activity. It's now starting to continue, and the pace of development, is going to look a lot different going forward due to what is happening in the debt and lending environment. But as we think about just from the supply standpoint, on the following slide, that buildup in supply was really doing a couple things. Obviously, from the pricing standpoint, everyone was using rates, which we track, to try and attract that tenant. There were a lot of new facilities opening up, and what that did is in order to attract those tenants, they were lowering their rates. And as the supply started compounding on itself, what you see is lease up times, the amount of time it took to take an empty facility and take it to 85% occupancy has been slowing. And so what the chart right here shows you, using Extra Space data that they put out there just as a rough proxy for the industry. But as you can see, facilities that opened up in 2016, they leased up very well. 2017, roughly the same. In 2018, what you saw is you started to see a slowing, which means 3 or 4 quarters after a facility had been opened, you didn't have that same occupancy level. And now if you look at facilities that opened in 2019, that continues to compound on itself. And the slide following this really tells the complete picture, which is that as you think about supply growth, it compounds on one another. So if you have, a couple years of 4% supply growth, really when you think about what's impacting the market, it's all 3 of those years compounded into what's impacting the market. So you went from 2016, where you had roughly 3% of the market undergoing some form of lease up, to now over 12%. So that compounding effect of supply growth had really been the primary force that had been impacting fundamentals across the industry. So the rate of supply was just being added at such a high pace that no demand could really keep up with that. Population growth couldn't keep up with that. No, nothing could keep up with that. So obviously, as COVID occurred, we've switched from a pure supply cycle to now a muddled situation where you're trying to figure out, is the health and the fundamentals a function of the supply growth, or is it a function of demand? The answer generally is both now.
Right. Interesting. So, I mean, I guess basically what I'm hearing is that 2020 was probably already shaping up to be a bit of a tougher year in terms of rate and occupancy pre-COVID. And now that we have this demand shortage due to the virus also in the mix, operators are probably going to need to reevaluate and fine tune their operations and marketing to match this, or to fend off these trends. Would you?
Yeah.
Fair summary?
That's a fair summary. I mean, it's something where you really have to be hyper aware of what's going on in your trade area now, because things are coming at you from both sides, supply and demand. So that's the way operators need to be thinking right now and on their toes.
Got it. Okay. Yeah, that's great. Thank you. So kind of moving on to the COVID part of the story. Obviously, as COVID started impacting our worlds, it changed a lot of things, turned a lot of things upside down. Obviously, as I mentioned, we are all very fortunate to be in self-storage, being deemed essential or not non-essential in all 50 states. But there's all kinds of new challenges, and operators across the country were, spent the last few months scrambling to create safe and contactless ways of doing business. We've been discussing a lot of these in our past webinar series. If you are still looking for guidance on that stuff, please do check out the recordings of all of our past webinars. We have them available on blog.storable.com. And we had a lot of great interviews with operators and other experts across the business. So today, though, I do want to focus about the impacts of COVID on the market and what has changed now from a consumer perspective. So, Eppie, let me turn it over to you to walk through some of that.
Yeah, thanks, Chuck. I think like most folks, we had some awareness of COVID in the months prior to its material disruption, but we were surprised a few times. First, with how quickly this went from exclusively an international problem to maybe just impacting the Pacific Northwest to total global shutdown. And in my mind, there's a clear demarcation for when this thing significantly impacted business for us. And that was on March 11th when Adam Silver announced the NBA season would be cut short. And I don't know if that decision was a catalyst for some of the activity that followed, or if it just stands out personally for me because I'm a big basketball fan. But around that same time, we started to see changes in our data that didn't look normal. So first, we saw a significant anti-seasonal spike in volume. So while the tops and bottoms have different magnitudes, all months generally follow the same reservation volume pattern for us. We typically see consumer interest higher at the beginning and end of the month with a trough in the middle. So it's more or less U-shaped. But March brought upticks in both visitors and reservations mid-month. And the reservation growth outpaced the visit volume increase that we saw. So consumer intent was very, very different. If we take a look at a slide here, we can see this displayed graphically. One of the things that we monitor on the Sparefoot side, in addition, is reservation count to email address type. And reservations to email addresses with a .edu domain traditionally remain pretty flat throughout the year and spike at a single point in time. And that's in late April and early May, every single year like clockwork. And we never see large upticks in this type of email address at any other time throughout the year. But if we click forward, you can actually see there's a spike that we saw that was clearly anti-seasonal here in the week of, I think it's March 9th. So sort of like the 11th through the 18th was the biggest period where we saw just a huge jump in reservation volume, in particular to students. So this pull forward of volume has some impact. With colleges and universities shutting down in mid-March, students really had to scramble to find a place to store their belongings, and we knew that college students tend to book smaller units on average. So the impact that we see isn't just on reservation volume level. We also see a skewing of price per square foot and average unit size due to this anti-seasonal movement. When we couple the shift of student volume with the first buzz of government-mandated closures also surfacing around that time, and folks who knew that they would need a storage unit in the coming weeks were inclined to reserve sooner. So that's part of the reason why we see this huge spike that's in the green box, that pull forward of reservation volume that might normally have happened a little bit later within the year. The commercial intent of these shoppers was atypical, but not really sustainable, right? They wanted to book and not shop. So that college spike and planner pull forward lasted in earnest around 10 days. So it brought us until just about the end of March, and then things changed pretty drastically. So mandated closures went into effect. People took social distancing requirements seriously. And, when the government orders started to take hold, we heard from a lot of operators who were obviously nervous about the potential impact on their business. And we were concerned about the impact as well. We were modeling out the downside effect of sustained forced closures and contemplating how the industry would change and respond if facilities weren't allowed to open or at least be manned. Thankfully, we didn't have to wonder very long. We were granted respite quickly as storage was deemed an essential business, which mentioned previously, and facilities were able to stay open. So even during the strictest phases of shelter in place, the result for us was that the vast majority of stores on our network remained open to consumers without disruption. We still worried about the downside impact to our thousands of clients. Even though facilities could stay open, would it be clear to customers that that was the case and that they could safely do business with storage facilities? We rolled out a number of big changes to try to support our partners on this front, including contactless badging and online move-in support. We thought it was important to make it very clear to consumers that they could still rent from our facility partners, that we had done the legwork of verifying who was still open, and that we knew who could accommodate their storage needs while respecting and prioritizing their safety and well-being. This approach seems to have worked really well, as we're actually seeing exceptional follow-through on our reservations. Where we were concerned that move-in rates might drop off, we've actually seen a contrary trend. Move-in rate is as strong as it's ever been on our volume.
Interesting. Yeah, so that's great, Eppie. Thank you. And late April, we started hearing from operators that it felt like the shock and the adrenaline of the health crisis had started to wear off. Not only had they solved a lot of the COVID-specific business challenges, but some states obviously started to relax their restrictions and reopen. So I'm curious, what is the data showing now as of late April?
So we're seeing performance start to rebound. Is volume rebounding? You bet. Is it like normal? Not exactly. So visit volume is back, and for us, it's actually pacing up year over year, which we're certainly thankful for. Reservations have also rebounded for us, but it's with a lower reservation rate. So it's taking more visitors to drive the same volume of bookings that we would normally expect. Now, to be clear, I don't know that Sparefoot's full rebound equates to complete industry recovery, though. Anecdotally, we've heard that there's probably two contributing factors to our volume uptick. Number one is actual recovery, and so people are shopping for storage again. And number two is a shift in consumer behavior. I've had a bunch of operators share with me that their walk-in volume is way down, and that phone volume is down, but less than walk-ins, and online volume has been hit the least. Now, I think that makes sense, especially in states that still have some form of a shutdown in place. Customers really don't have confidence around what types of businesses are fully open and accepting walk-in traffic. And that means that they're more inclined to reserve in advance and to do some research versus just showing up at your potentially not open facility. Are the types of consumers who are shopping now the same as those that we're used to seeing? Again, I think the answer is not exactly. there's lots of supporting data that suggests that the mover segment in particular is underweight right now. Redfin has actually released some really fantastic data on their blog that they're regularly updating that highlights the state of the residential real estate market. And they indicate that a drop-off in new real estate listings was precipitous beginning in the week of March 9th, so aligns with the timing that we saw, and that their data shows a bottoming of that on the week of 4/6, almost at 50% year over year. It was minus 49.6% on year over year new listing volume. The recovery from that bottom has been steep. So it rebounded through the week of 5/18, returning to only 13.6% down on a year over year basis, but has since retraced some of that decline. So we're kind of sitting in at 20 to 25% down in total inventory versus last year. And the implication of that is for a lot of consumers, even if they want to move in, they might not be able to right now.
You mean like people can't find a house even if they want one?
Yeah. So another interesting data tidbit along those lines is that home buying demand is actually up. So people are searching for properties. That's up 22% versus pre-COVID levels, again, according to Redfin. But the substantial shortage in available inventory is impeding transaction growth. So from my perspective, that is maybe equal parts discouraging and encouraging for storage demand. So the immediate implication of fewer real estate transactions is lower demand from the mover segment for storage. But as residential real estate inventory returns, and it will, we would expect that the growth in demand to result in a lift in transactions on the storage side. The only complicating factor that I see there is if furloughs will impact the ability of some would-be movers to qualify for a mortgage. But in general, I think there's reason to be optimistic about demand returning. And I also think that we're likely to see that demand return more heavily skewed toward online channels than in the past. Right? That's a trend that I think everyone would agree we've seen. Right? It's been up and to the right for a while. But I'm inclined to believe that based on consumer behavior data, that the slope of that likely steepens.
Yeah, exactly. I was just going to say, I've never bought into the idea of pent up demand, but for the first time, I think you could say in the industry that you've now got true pent up demand as it relates to self storage.
Yep, it's got to be a first time for everything.
Yeah, exactly.
Yeah, I'd also note that I think consumer behavior isn't the only thing that's different right now. Right, so we're seeing changes in operator behavior too. We see lower prices booked. And I view this as a combination of two things, both aggressive discounting by operators to attract new customers and a skewing of unit selection to larger sizes, which tend to have a lower price per square foot. And if we skip forward a slide here, you can see this slide clearly shows the college student spike that I talked about previously. Right, college students book smaller units that have a higher price per square foot. We see, super anti-seasonal movement in that green box, and then a huge drop-off in price per square foot book as operators try to change their behavior to attract as much volume as they could get from a smaller pie of available storage purchasers. The positive note here, I think, is that we're starting to see a rebound, however slight it is, off of that, call it minus 16% low, moving closer into the minus 10% range. I mentioned contactless move-ins on Sparefoot previously. I did want to touch on that briefly. Consumers are showing a real preference for contactless move-ins where available, and I think this is an interesting trend for operators to take note of. On the Sparefoot marketplace, we rolled out the contactless badging feature, and we saw a rapid adoption from operators. We now have roughly 2/3 of the facilities on the network adopting a contactless protocol and featuring a badge on their listing in the marketplace. A higher number, nearly 80% of reservations on the marketplace, though, are going to contactless facilities. So by adopting that process, they're grabbing an outsized share of reservation volume. I also think maybe the reasoning behind that is important, right? I think it increases confidence that a facility is open that it's accessible, and that it's responsive to the needs of its customers. We're also seeing a growing preference for online move-ins with a real benefit to operators. We see a 3.5% lift in move-in rate on SpareFoot when we offer an online move-in option. And that's another feature that we've rolled out in direct response to the needs of operators in light of the implications of COVID.
Awesome. Eppie, that's just really fascinating data. Thank you for sharing all of that. So I think what would be good to do now is answer a couple of the questions we've had come in from the audience. So Matt, can you read us the first one?
Yeah, absolutely. Can you guys hear me?
Yep.
Yeah, so the first question that came in is one data point that one of our listeners noticed that was missing is this concept of collections and delinquency rates and reporting. And so Chuck, they're curious from the Storable side, is that something that we could share what we've been seeing there?
Yeah, that's a great question. So Storable doesn't actually, all the data we've been looking at today from the Storable side of things is from SpareFoot, which is our consumer-facing marketplace, and most of that information is all available and published on the internet. We don't mine our clients' data, which is where you would see the information about delinquency and collections. But I can speak anecdotally and tell you that some of the operators I've been talking to have been telling me that they've kind of seen anywhere in the range of 10 to 30% year-over-year increase in delinquency or unpaid charges. And more recently, what I've been hearing is that those who are delinquent are staying delinquent, but there's less new units coming into the pool becoming delinquent. So it seems like that trend is improving, but that's, again, based on just what I've heard from some of our customers.
Thank you very much. And we got one more question. Cory, this one's for you. And we had a question about your contactless storage, like, is it legal marketing that you guys had done this past week? And so they were curious if you could just kind of touch on that, what that piece is about, and maybe point people in a direction of where they can learn more about it.
In terms of the content, I'll let the article speak for itself. We are more of a consolidator of information from around the self-storage industry. So we take articles from various parts of the industry and try and consolidate them for people's consumption. But if you go to radiusplus.com, that article will be there, and they'll be able to digest that and fully take in everything on the contactless approach.
That's great.
Awesome. Thank you very much.
Were there any other questions, Matt?
That covers it. We had a couple more, but we're running a little low on time, so we will follow up with you guys after the fact, but I think that's good to move forward.
Awesome. Thanks, Cory. Thanks, Eppie. And Matt, I'll hand it back over to you.
Awesome. Thank you, Chuck. So I want to echo what Chuck just said. I really want to take a moment to thank all three of these guys, Chuck, Cory, and Eppie. That was an awesome discussion. So we appreciate you guys lending your expertise and taking the time to join us today. With that being said, I think based on everything you guys heard today from the operator side, I'm pretty confident most of you guys are probably asking the natural follow-up question, and Chuck alluded to this earlier, but what can we do to take action on this, right? How can we set ourselves up for success and kind of fend off these market forces? And so the answer to this question is really at the heart of the 4 Operator Imperatives webinar series. And so we wanted to take today to kind of lay the groundwork of why you should care about it. And over the next few weeks, what we're really excited to do is really dive deep into those actions that you can take to improve your kind of business fundamentals. And so each of these imperatives were distilled from countless conversations we've been having with our clients at Storable, other vendors, subject matter experts, et cetera, over the last year or two. And they're really at the core of how our savviest operators are approaching optimizing both the operational and marketing performance of their business in the face of these market forces. So I wanted to take a quick peek at each of them and just give you a little bit of a teaser for what we'll be discussing over the next few weeks. So first, as I mentioned before, is optimizing your marketing spend. And this operator imperative is all about identifying the most effective marketing vehicles that you can possibly use. And so we're going to be discussing all of the sources of marketing, including some that you don't even need to pay for, to make sure that you're getting the most bang for your buck. Next up is rethinking the tenant experience. And we've seen that even before COVID-19, there was an increasing shift to digital channels for interaction. And Eppie did a really good job of illustrating that today in his presentation. And whether it's paying bills, checking records, or online move-ins, there's no doubt that people have been shifting towards digital. And so with COVID, we're seeing an acceleration in the space, and we're going to be discussing how you can utilize kind of a combination of technology, process, and people-powered stuff to meet the evolving needs of your customers. Next is simplify and automate your processes. And this is about three main concepts. One is how do you get the most out of your people? How do you make their jobs easier? And how do you give them more time back in their day to focus on other important tasks, such as working with your customers? We're going to be discussing the concept of practical automation, which is our belief that not all facilities are going to be fully automated tomorrow. We think that's unreasonable, but we do believe there's a middle ground where we believe operators are going to be spending most of their time, and that's only been accelerated by this health crisis. And we're going to discuss how you can get to that middle ground and kind of find the right balance of automation for your company. And then lastly is amplifying operating revenue. And so this is one that each operator is going to need to evaluate for themselves. Questions such as how are you pricing your vacant units? What about your occupied ones? How's the rest of your market handling this? Are you looking into ancillary revenue streams that make sense for your business? We're going to discuss all these concepts and more over the coming weeks to kind of help you tailor a solution that makes the most sense for your business. And then lastly, as a quick reminder, in 2 weeks, we're going to be diving into our first operator imperative, which is optimizing your marketing spend. And in particular, we're going to be hosting a conversation on the essentials and the benefits of SEO and what that can do for your business. With that being said, that concludes today's webinar. So if you guys do have any questions that come up, like I mentioned before, if you've already submitted your question, we'll follow up with you. We've got those logged. But if you have any that come up over the next week, feel free to send us an email at webinars@storable.com, and we'll get back to you as soon as we possibly can. But to all of you guys out there, stay healthy, stay safe. We'll see you in 2 weeks for our presentation on SEO. Thanks for attending, and you guys have a great day.
Thank
Thanks,
you.
Sean.